Hello, and welcome to Stock Market Fever. Today is Monday, June 13th, 2022, and what a wild day we had in the stock market last Friday, with the government's inflation report coming out with news that can only be described as beyond bad. U.S. inflation was reported to be the highest in 40 years. This led to forceful selling of securities across the board, and the Dow dropped over 800 points, as investors feared the Fed would respond by ratcheting up interest rates ever higher and faster to tame inflation, perhaps forcing the economy into an unavoidable recession. You know, whenever you invest in the stock market, you're assuming the companies you're investing in are well managed and are poised to grow through business expansion and innovation. You assume that the companies you're investing in can keep up with potential new competitors or innovations so that their sales will grow. And you also assume they can carefully manage their cash flow and balance sheet through their marketing and capital allocation decisions. But in spite of company being well managed during the normal business cycle, companies facing inflationary cycles may not do a good job during inflationary headwinds. Retail companies, for example, might have too much inventory on stock to meet diminished consumer demand. Witness Target Store's recent announcements. Likewise, trucking companies could find themselves under pressure as shipments are curtailed in anticipation of inflation-induced recession coming on the horizon. And other companies might be involved in sectors that have peaked in the times leading into inflation, but might be facing serious sales and profit reductions as the Federal Reserve ramps up interest rates to tame inflation. Consider the home builders, for example, who might start seeing serious profit squeezes as the Fed ratchets up interest rates, pushing many potential buyers out of the market. But while some companies could find themselves in serious trouble during inflationary times, others seem to thrive. And as now, in June 2022, when the government reported that we are having the highest inflationary times in 40 years, we should very carefully consider how we allocate our investments. In this video, we'll list, analyze, and evaluate the top 4 stocks we believe will do best during inflationary or recessionary times. And you'll want to absolutely be sure to stay to the end, as our number 1 pick might be a big surprise. Okay, here it is. Stock Market Fever's number 4 stock pick is Pfizer. Pfizer has, of course, become flush with cash as a result of the worldwide adoption of its COVID vaccine and more recently widespread distribution of its treatment pills. Pfizer's annual revenue exploded from $41 billion annually in 2019 and 2020 to over $81 billion in 2021, and analysts estimate Pfizer's revenue to grow to around $104 billion for fiscal year 2022. Pfizer's earnings went down from $1.85 in 2019 to $1.18 in 2020, perhaps as a result of extraordinary expenses to bring the COVID vaccine to market, but then soared to $3.93 in 2021. It can reasonably be expected that in spite of inflation or recession, people will continue to take Pfizer's COVID vaccine and treatment regimen, and likewise their entire portfolio of pharmaceuticals. In June of 2022, Pfizer was trading at around the $50 price range, and 12 out of 22 industry analysts rated the shares a buy or strong buy, 9 a hold, and 1 sell. With an average target of over $58 per share, Pfizer doesn't seem to offer spectacular upside potential, but we believe that it is a relatively safe bet given the inelastic demand for Pfizer's products and its potential to grow new revenue streams from its own portfolio and its just completed acquisition of ReViral. And that is why we include Pfizer shares on our list of stocks that should do well during inflationary or recessionary times. Our number 3 stock picked to do well in either inflationary or recessionary times is Cummins. Cummins Inc. develops, produces, sells, and maintains diesel and natural gas engines, as well as electric and hybrid powertrains and components. In a nutshell, Cummins powers America's trucks, and America's trucks power every aspect of life in the USA. Although the trucking industry can be highly cyclical and could slow down during a recession, there has been such an undersupply of trucks on the market due to supply chain issues that even a big recession might not be enough for truck manufacturers to get caught up with a pent-up backlog in demand. And if Cummins is forced to pay more for parts and labor due to inflationary pressures, then in our estimation they should be able to pass along these costs to the end users. Cummins sales were $23 billion in 2019, and then took a dip down to $19.8 billion in 2020 when the world closed down due to COVID, only to rebound to $24 billion in 2021. And as their sales rebounded, so did their earnings. Earnings per share dipped from $14.42 in 2019 to $12 in 2020, only to rise back strong to $14.61 in 2021. Not all analysts agree with our bullish assessment for Cummins. Out of 24 industry analysts covering the shares in June, 7 rated Cummins buy or strong buy, 14 hold, and 3 either underperform or sell. Cummins share prices as of June 10th were $205.50, with an average target price of just under $250 per share. Yes, we believe that Cummins is a good stock to hold in inflationary or recessionary times due to America's pent-up demand to update its aging truck fleet with the more fuel-efficient and environmentally friendly engines that Cummins develops and provides. Our number 2 stock pick to do well in either inflationary or recessionary times is Marathon Oil. Marathon Oil Corp. Is an independent exploration and production company focused on 4 of the most competitive resource plays in the U.S., complemented by a world-class integrated gas business in Equatorial Guinea. While the overall stock market has been dismal this year, energy companies have been on a tear, powered by the upward surge in oil prices. Their shares surged, of course, in tune with the price of their main commodity, oil. Oil had bounced around the $100 per barrel range through the beginning of the year, but then as tensions grew with Russia threatening and then invading Ukraine, oil prices have gushed up to the $120 per barrel range, and thus Marathon Oil shares roared. Marathon has seen its share price just about double this year, from 16 to over 30 in the span of 6 months. Marathon's revenue dipped from $5.1 billion in 2019 to $3.1 billion in 2020 as the world locked down in response to the pandemic and the price of oil plunged to about $25 a barrel. But as the world reopened, so did demand for oil, and with oil's rise, Marathon's revenues shot up to $5.5 billion in 2021, with projections of $7.6 billion moving forward. With trailing annualized earnings of $2.86, Marathon is trading about 10.5 times earnings at the $30 price level, making it a very reasonably priced growth stock. Making Marathon even more attractive is its commitment to return of wealth to share owners. In their first quarter 2022 earnings report, Marathon boasted of their commitment to strong corporate returns, sustainable free cash flow, and market-leading return of capital to shareholders. Also particularly noteworthy in that report was their 60% of CFO return to equity investors over the last 2 quarters through base dividend and share repurchases, and $1.6 billion of buybacks executed since October, 11% share count reduction in 7 months. And we believe the good news will only continue for Marathon Oil, and we believe the price of oil will continue to gush upwards, and in spite of inflationary or recessionary pressures, and Marathon Oil shareholders will be rewarded. And so, here it is, the moment you've been waiting for. We're down to our number one pick for a stock to do well during inflation or recessionary times. And we'll be glad to tell you in a moment, but if you like this video and would like to see more like this, please click the like button and subscribe to receive future stock market news, analysis, and alerts right here at Stock Market Fever. Thank you very much. Okay, back to our forecast. While we do not offer investment advice, we gladly offer our opinion. And here it is, our number one stock pick that we believe will thrive despite inflation or recession is Merck. Merck is a leading international drug developer, manufacturer, and distributor. They declare, "For more than 130 years, we have brought hope to humanity through the development of important medicines and vaccines. We aspire to be the premier research-intensive biopharmaceutical company in the world. And today, we are at the forefront of research to deliver innovative health solutions that advance the prevention and treatment of diseases in people and animals. With a well-diversified portfolio of drugs focusing on cardiovascular, respiratory, and infectious diseases, cancer, nervous system disorders, immunology, and women's health, Merck doesn't have the high-profile COVID vaccines or treatments that have brought fame and wealth to Pfizer and Moderna, yet Merck has been growing in sales and profits. Merck revenues have grown from $39 to $48 billion from 2019 through 2021 and are projected to reach $57 billion for 2022. With trailing earnings of $5.48 per share, Merck is trading at an attractively valued 16 times earnings at the $87 price range and under a 12 forward price earnings. As a bonus, Merck announced on June 7th that a third phase study trial found that their COVID oral treatment pill, Lagevrio, had a 33% less need for acute care visits or a COVID-19 related acute care visit. Though this announcement does not guarantee the drug will be approved, it does hold the potential for a significant source of new income for Merck. Merck is also looked upon favorably by industry analysts. As of June 2022, out of 21 analysts covering the shares, 11 rated Merck a buy, with the rest giving a hold rating. We at Stock Market Fever are including Merck on our list of inflation and recession-resistant companies due to their record of success in developing and distributing new drugs, along with the relative inelasticity of demand for drugs. People will get sick and need treatment no matter what is happening in the economy, and that is why we are bullish on Merck. Well, there you have it, our top 4 stock picks to be able to withstand inflationary or recessionary times. This is what we believe, but what do you think of these stocks? And are there any picks here you don't believe will do well? Or are there any stocks that you would add to this list that could withstand the pressures of both inflation and recession? Please leave your thoughts and comments below, as we'd love to hear from you. And please be sure to like and subscribe to Stock Market Fever for future actionable stock market news, analysis, and alerts.